Hello, ladies and gentlemen. This is IBM Pod TV program, Modern Investing. My name is Sasha Starr. I would like to bring our panel for today. We'll start with Milan Samberg, author of
Everybody.
Monday Millionaire, Nick Poliveda, founder of the network. Welcome to the show. And also Peter Bennett, the veteran of Wall Street. My co-host, thank you, Peter, for participating. You start with your report, everything what we need to know, right? Hello, Peter. Peter, can you hear me?
Peter, can you hear him?
I can hear you, Sasha.
Oh,
Peter?
Okay.
I guess he can't.
Okay, there are some online programs. Milan, tell us what you've seen on the market interesting in the last week or so.
The striking thing is you have a couple of times brought up the subject of the efficient market. And so you asked me what I see last week. Following the efficient market theory, I'm going to expand on it for a little while. We should be checking our portfolios about twice a year, not twice a minute, like many people do. So efficient market theory was first articulated by Eugene Fama. It was his PhD thesis about 40 years ago or so. He ultimately won the Nobel Prize for it three decades later. And what he said is, everything that is knowable is known to all. Therefore, nobody can have an advantage over anybody else. So Burton Malkiel, who was a professor, I think, at Princeton University, published a renowned book called Random Walk Down Wall Street, in which he said that monkeys throwing darts at stock quotes could do equally as well as professionals like Peter and Nick and you and me. So the Wall Street Journal ran 14 years of 6 months overlapping studies where the Wall Street journalists were throwing darts at the stock quotes, and they compared their performance, the dart portfolio, with professionals, and they were indistinguishable. You could not tell them apart. That is, nobody can have an advantage. Here's Peter, he's beating the market. I wonder if that's sustainable. According to peer-reviewed journals, highly respected, high impact factor peer-reviewed journals, that is not sustainable. So when we go from market cycle, from peak to trough to peak, the percentage of portfolios that equals the S&P 500 is much closer to 0 than it is to 10. And so that's the way we invest. And with the Monday Morning Millionaire, we have about 400 followers. And we do surveys occasionally. And yeah, they spend up to 15 minutes a week managing their portfolios. Because if you buy the American economy, one of the strongest in history, by buying shares in an exchange-traded fund, which tracks the S&P 500, it's almost impossible to beat in the long run. In the short term, yes. So in the short term, the market is dangerous, but in the long term is the most productive way to invest, unless you're cherry picking. In the short term, money is safe, but in the long term, it will absolutely lose purchasing power. So what do I have to say about last week's performance? Well, I have to confess, I do check the market a little more often than I should, but really I should be checking it twice a year. As
Wait, Milan, not just last week, the last 6 months, just so you, but I would add that, look, your strategy may be really good, and I may start doing some S&P 500 funds in 6 months, a year, 2 years, when the market realizes probably that we're in a long cycle of inflation, just like the 70s. So it may take years until the market realizes that. And everything is past based. And yes, it's been a great run. And the Fed Reserve, by the way, has been pumping up the market for 20 years by lowering interest rates, but they cannot go below zero. So the past is not always the future. If I could do the news quickly, Sasha.
Sure.
So we'll start with the S&P 500, coincidentally. So we're now heading at 629, and as of tomorrow, basically, the S&P will be in its lowest, worst performance since 1970, which is no coincidence because that's when inflation started going crazy. But also, it's the 5th worst ever. And here is a chart. There is a point.
Yeah.
And this is where we are. And interestingly, right now, we just took a little bounce, and you could see we're right in the middle there. So using Fibonacci theory, it could go either way, but this is a long-term trend. And so, but it also points out a different thing, which is very interesting, which is it's very hard, and Milan, you probably will like this point, it's very hard to catch the bottom because,
don't even try. Don't even try. Yeah.
Right, exactly. Well, I disagree. But and I've been disagreeing for 6 months. So far I'm right. We'll see. But you could see that each time it fakes down, it fakes up, it fakes down. So the question is someday and maybe tomorrow, Milan, or maybe in 10 years, someday it's going to get out of this channel and it's going to break to the upside. Yeah. And as a matter of fact, that's what a trader would do. I'm not really a technical person, but that's what they would look for. But you can see in the middle, it did break to the upside and then fell back down again. So that was another fake. So there's so many fakes, so it's hard to say. But anyway, the problem is this. This is the CPI, and nobody knows when it's going to calm down. But right now, it's going crazy. Inflation is going crazy. And this is an interesting chart, which shows that starting in 1983, they changed the CPI measure. But now this is complicated because I always talked about the fact that the government around the 70s, somewhere around there, changed the CPI measures to reflect substitution. So they'd say, well, if carrots cost $1 million, you can buy lettuce, So they had this method of always adjusting. So the government's always trying to push down inflation numbers. But this chart actually shows a second way that they kind of cheated in a way, because what they started doing is back in 1983, sorry, that was the right way. 1983, the government started measuring rents by surveys instead of actual rents. And immediately inflation went down because people, what they do is they do the survey of people who own homes. If you were going to rent out your home, how much would it be? Well, people tend to be behind in what they expect to get for rent. So by this chart, just on that one adjustment, and I've seen other adjustments that say we're already in 14% inflation or more based on the other substitution method. But based on this method, we're at 11 or 12% CPI. So this is unsustainable. Moving on, at the G7, Christine Lagarde said that she wants to, the head of the ECB, quickly raise rates, quickly and definitively. President Macron said energy prices are unsustainable, but that's the problem. They have to be sustained because there's no other options that I can see. The one good thing that came out of the meeting was that 4 countries are banning exports of newly mined Russian gold. So that's the second largest export from Russia. And unfortunately, Russia's been shipping out just about as much oil because China and India are taking the oil and they're refining it and sending it to the West. So they're not really cooperating in that sense, and they're still burning oil. the European and energy itself, which is one of the main causes of inflation, obviously, is the European Union is set to ban nearly all Russian oil exports by the end of the year. But where's that substitute going to come from? OPEC just underproduced its target by 2.6 million, and they have no incentive really. They are not going to produce what we want, and this is how they're cheating, by the way. What they do is they say, okay, we're going to raise our quotas, but they raise it for all the countries. But only a few countries have extra capacity, like Saudi Arabia. So let's say they assign a certain extra quota to a company that's already underproducing. They don't have the capacity. So they say, oh, look, we're raising the quotas, but the oil doesn't come out of OPEC. And they're happy to do that. They know maybe that in 20 or 30 years, their business is going to be drained. So why are they not going to try to get some good money for their oil? And they need the money maybe to change their business model, if you call it that. Chinese demand is expected to increase a lot next quarter, and in the fourth quarter, because they're reopening. So that's going to cause even more oil shortages. U.S. crude balances of WTI. This is a amazing drawdown. In March 19th, it was 1,140 million, and in June 23rd, it was 936 million. So it went down by 200 million in just about 3 months, and U.S. production only went up from 11 to 11.9. So we have a shortage of about over 2 million a day, and it only increased by 0.8 million, but we still have a shortage of big shortage. Biden came out with his energy plan, either officially or unofficially, I don't know. He said that he wants to suspend the 18-cent gas tax, which may or may not happen anyway because Congress would do it, but that's a drop in the bucket.
Yeah.
2, he's asking the states to suspend their gas taxes, but some states have already done that, and many states have said they won't do it. So this is nothing. It's all nothing.
Not a lot. Still not very much, is it?
Yeah, he's asking the oil companies to use their profits to increase refining capacity, but they're already at maximum refining capacity. And 3 and 4th, they're asking gas station owners to pass on their savings. Gas station owners don't make a lot of money, and they've always priced the same way. They get the oil, and it takes some weeks to sell it, so they might be a little behind, but that's what it cost them when they bought it, and then they resell it at a very thin profit margin. So basically, he's saying he's not going to help at all. And, he's dreaming of maybe of a transition. So in May, he said the following: when it comes to gas prices, we're going through an incredible transition that is taking place, that God willing, when it's over, will be stronger, and the world will be stronger and less reliant on fossil fuels. So this is a dream, I guess, to me, because it's not going to happen smoothly. And it could have happened a lot better if he had done other things, like cooperated with the energy companies instead of fighting them every way. But so basically, he's happy because he thinks this is going to translate into more EV sales. But I don't think it's going to be a long time before a strategy kicks in, and it's going to be very painful. The Federal Reserve President of New York, John Williams, said just today, I think it was, he said he wants to see interest rates hiked by 0.75, which will probably happen, and he wants to see rates at 3 to 3% by year end. I personally don't think they're going to even get there, because I think what's going to happen is rates will go into a recession. And by the way, and he says he does not expect a recession. What else is he going to say? He's a Federal Reserve, but a lot of people are saying that. The consumer survey for Michigan says that this was the lowest reading ever in their history. Everybody, corporate executives, consumers, everybody's got a very negative outlook, but the market is still pricing in good earnings. So there was an article in Barron's. It was actually a letter to the editor, but I thought it was a pretty valid point. They said if corporate profits actually go down by another 10 to 15%, and they easily could in a recession. If we have a recession, it's not going to be good for earnings, obviously. And the market is priced at a 16 PE ratio. Their S&P target is 3,200, which is quite a drop from here. And they said, but the market typically overshoots, so it could even go lower than 3,200. That's a big drop from today. And I think the dangers are on the downside, right now. I don't see any upside influence. Where's the good news? I mean, maybe if there's not a lot of good news. Maybe some miracle will happen, or, something will happen that'll be better. In the U.S. crypto markets, another company had problems. They said somebody stole 100 million in crypto, which is, one problem after another, Beanie Babies, tulips, a scarce amount of nothing is my comment. And then finally in Ukraine, there's problems because Russia seems to be making slow progress. I think, Sasha, you tell me because you follow it closer than me, but they seem to be making slow progress. They now have 20% of the land. But here's the problem. The Biden administration, a number of officials have said, I don't know if it was on or off the record, that they don't expect Ukraine to win the war. So we're kind of in a stalemate. But here's the problem. Russia's not going to concede, one. And they have two things going for them. One, nuclear, which I don't think they're going to use at all, but they have the threat, which keeps the U.S., and other countries at bay. They don't want to help too much. But the other side is the big thing is gas, natural gas. So even though Europe's going to cut the oil, they have now the Nord Stream gas pipeline, and Europe is going to need that gas in the winter. So they have a tremendous winter strategy. They can cut Ukraine off from gas. They can cut Europe from gas, and there's going to be a lot of pressure to settle. So this is going to be very strenuous in terms of why also 89% of Ukrainians do not want to give up an inch of land to Russia. So now the politics, and Zelensky is not going to be wanting to give it up. They don't want to give it up. It's right, morally. So maybe they'll settle in a year or two, but maybe not. So it's a problem. So I'll close on that. I have one or two other humorous things, but I don't want to take up too much time. Mm-hmm. So anyway, the question is, when do we catch, if we love the S&P, Milan, or anybody, Sasha, Nick, when do we get in to the stock market? Because right now I'm down to 15 holdings when I was at 60 a year ago, and I've been trimming and trimming and trimming, getting more and more defensive. So when do you get back in? Just jump in. But
you raise a lot of points, Peter. So let me address some of them. First of all, let's go to the nuclear question. The countries that have nuclear weapons agreed quite a while ago, and that would include India, Pakistan, Russia, United States, probably Israel. I don't know how many others have nuclear weapons. They have agreed that to press the button requires the total agreement of 6 individuals. So there is no Putin who can press the button. It has to get past the second guy, which has to get past the third guy, which has to get past 6 people.
In each country, are you saying?
Because
in each country, are you saying?
In each country, that's right. Because each of those, they assume that someday some megalomaniac moron will be running the country, which could be happening in Russia now. And to prevent nuclear, it's called mutually assured destruction.
Oh, yeah.
To prevent mutually assured destruction in each of the nuclear countries, 6 people have to agree to press the button. That's very unlikely to happen. Now, back to the energy problem.
But what about in Russia? Do they follow those rules?
Well,
they do. All 6 people agree ahead of time. So.
Yeah, Putin, right? And the other guy who might shoot Putin. And the other guy who might shoot Putin if he really tries it.
Now, you're talking also, Peter, about energy crisis. In this morning's Globe and Mail, the Globe and Mail is Canada's leading newspaper, and this morning's paper talked about liquid natural gas, which will be manufactured in Canada, made in Canada, and shipped to the West Coast to go elsewhere in the world. So that's new as of this morning, and that'll change the picture.
Did they approve some pipelines, Milan? Is that what happened?
I'm not sure how that's going to work.
Okay, because they need pipelines to go from
to take it
Canadian producers, but Canada will be a huge producer of energy in the future.
Can they not ship it by rail? Liquid natural gas?
It's not as efficient.
Yeah, anyway, I mean, even if they can ship LNG, I mean, U.S. is shipping more LNG. It can't substitute for the world's, energy needs, but it's going to help. It will create more energy, but it's not like they're going to all of a sudden have enough to power the world,
Yeah. Well, not all of a sudden.
You need ships. You need ships. You need trains. I mean, pipeline would help a lot. They've been fighting with the Indians, And I don't know where they are in the negotiating to get it through British Columbia to have some pipelines. Pipelines are much better than trucks. Truck holds very little oil.
Yeah.
You know, if you get a pipeline, you can pump it out, and it's. But
No,
last I heard, they were in negotiation.
we're not supposed to call them Indians. I have.
Sorry about that.
At least a number of my patients were Native Americans, and they say,
Okay, Native Americans.
Indian, okay, I've been an Indian my whole life, so okay, you can call them Indians. But one other item that you mentioned, Peter, was traders and traders' activities with the S&P moving the way it is. Traders are losers. Unquestionably, traders are losers. There was a study done in Brazil of 20,000 accounts, and the percentage of those accounts who made money was less than 1%, and they equaled the minimum wage in Brazil. Traders are losers. Wall Street loves them. Wall Street and Main Street have a huge conflict of interest. I keep mentioning that all the time. They love traders. Traders are losers. Traders win often enough to
Sasha?
but not often enough.
Sasha makes so much money on trading. It's unbelievable.
But this is
You're on the wrong show because you have a bunch of winners here.
He's selling the stuff, not buying.
I'm selling
Uncovered calls.
options, and
Selling
although I
It's
do
still
lose
trading.
from time to
It's still
time,
trading.
yeah, we can call it trading.
It's definitely trading.
Yeah, but
You're in the casino.
yeah, that's right. This trading is positional trading. It involves certain risks. On selling side, you are much more often right than wrong because 90% of the option expire worthless. So if you're selling something that you collect some money, and at the end of the day, it will expire worthless most of the cases, as I said.
Yeah, right.
So then you definitely have an edge in this trading. But of course, you have to understand what you're doing, and I wouldn't take just any position to trade. I would just see what are the risk-reward ratio. It's very difficult to pinpoint to exact numbers. Sometimes I'm exiting the trade, even there are chances that position would expire worse, but I'm taking profit because it allows me to settle on some kind of a gain and employ the capital for some other.
And you've outperformed the S&P 500, Sasha, correct?
In my fund portfolio, yes. On overall,
in your total portfolio, in your trading portfolio, in your fund portfolio.
Yeah, I'm talking about trading fund portfolio. So
okay,
yeah. I'm now analyzing position as to take actually position on the Apple and sell 125 puts. I think it's getting to very attractive position. I think it's going to be a winner, but I'm talking about selling long puts, something maybe December or January expiration. First of all, the premiums are much loftier than the close, say, August puts. I would prefer probably to do December, and also there are more chances that market will turn higher by December, November, or even January. So I have a lot of time, and I have a lot of chances for market to finding its bottom and maybe turning around, or maybe even not. So the worst case scenario, I will end up with the Apple stock at $125 a share, where it's now 140.
And you're thinking about doing this soon, Sasha?
Yeah, maybe even this week. Yeah.
Wow.
Yeah, I'm following. Yeah, well, the downside of it is that I will miss a move up the market, that maybe even tomorrow market will be positive, and Apple stock may go to 100.
There's another downside, Sasha. Another downside: when you sell puts, you don't own the security. If you sell covered calls, you own the security.
Yeah.
And if you own it at the right time, you will collect dividends on it. That never happens with selling puts.
I agree with
that's
that.
not true, Milan. If you sell puts out which are way above the strike price, you can own it. I did that the other day.
Then you wind up owning it. Yeah, right.
Yeah, you can own it. In other words, let's say I had a stock I'm interested in that's trading at 16.50. I sold puts at 25 because I didn't want to put the cash in, and then I actually bought the call at 25 too. This is on USAC, which I think is a little speculative, but I'm trying to see what the next earnings report is. But I mean, it has a 13% dividend yield. and if it's another good report, I'm going to want to own more. So I sold the so this way I effectively bought the stock at 16.50, and then I covered it with 15 puts. But I put no money into the deal. I took money out, and basically I'm going to own the stock one way or the other. The calls cost almost nothing. So you can own stock with puts, but either way, you're the casino. Which is a good thing to be. The casino always wins.
Dylan, you see, the thing is, with selling covered calls, it implies that you must own the stock
Yes.
to sell covered.
That's why it's called covered. Yeah.
Exactly. But let's see, if I'm buying Apple today at 140 and I sell, say, 150, say July, maybe August call, I will collect premium, but in a way, if the stock will indeed go down to 125, and many people agree that the bottom for Apple is 125. So in this way, my loss, or at least paper loss for sure, on the stock will be way more than premium collected on a covered call. So
with annoying frequency. Yes, that's right.
Yeah, so this is quite possible scenario. So I'm waiting, selling puts way against owning potentially Apple shares at 125. And first of all, if I'm selling puts, I will collect a premium, let's say $10 for whatever puts there might be. So my effective cost of Apple will be only 135, not 125 if I'm exercised. So with the stock at 140 now, my loss is manageable, let's put it this way. And I think depends on which put I will sell. I may collect actually much more than $10. I can collect probably $25 if I will sell, say, which is a little bit riskier, but of course, let's see, I will sell 145 put.
And what's Apple at today, roughly?
140.
Oh, okay. So
Plus minus. So this is very aggressive strategy, selling
that would be aggressive.
145, because the likelihood of you being exercised is tremendous. So let's see. In fact, even if the stock will go, say, to 130, you may be assigned even before the expiration of the put. So you will end up, but again, if I will collect $25 and I will sell a put, and I will end up with stock at, say, 145. And I collect $25 on put. So, in fact, again, my intrinsic value or price of the Apple stock that I would own in that case will be only $120. So that's a math that you can live with, and until
You know what? I would add something to that, Sasha. That I mean, first of all, I'm waiting. I don't like. I have some Amazon puts I sold way out of the money, and I'll own Amazon, which is fine with me because it's the only tech company I really love. Although I like Microsoft too, but first of all, I could also I'd love it if I saw the S&P. If I felt good about it right now, I could sell S&P puts also above the S&P and capture some of that and get the premium too. But personally, I'm waiting, at least through the fall until the market realizes, to me, inflation is going to be a long-term problem, and I think the downside is huge compared to the upside. I just don't see everything's going to turn hunky-dory all of a sudden, and everything's going to be great with all these out of control inflation on rent, food, energy, the world situation. I saw an article that said there were 16 different reasons why inflation's out of control right now. And I don't think it's going to be like, oh, we're getting a 2% reading all of a sudden and everything's back to normal someday. But here's what I think is going to happen. Inflation's going to go through the roof. And then at some point, prices are going to get so high, it'll crush the economy. We'll have a recession, which is really what the Fed is probably expecting and wants, because they need to slow prices. And then at some point, prices will stop going up. But that's because they'll be so high, it will hurt the consumer and companies and everything. But I think we're nowhere near there. But, but whether you do it now or later, you are the casino. And even if it goes against you, you're starting with an edge, on selling options.
Because essentially I'm selling time. So
Exactly.
people are, imagine that you are on a market, let's say a bazaar. So you're standing and you're sending people lining up and saying, what are you selling? Oh, I'm selling time. Oh, okay. I'd like to buy time. How much you want to pay for it?
That's
Well,
true.
let's see. I want to pay $10. I said, no. I'd sell at $25. If you pay me $25, I will sell you time. So
exactly.
people will haggling and so on. So of course, it's I'm taking it to extreme, but in a way, I like the environment that you don't see actually a person who is buying time from you. You don't care how he looks,
Yeah, that's true.
how old is he, or what's his
Well,
race.
they're trying to hedge their risk. They have a reason for buying the time. I
I'm
mean,
pretty sure. Yeah.
maybe they're
Well,
trying to hedge their risk, or maybe they're scared of the market,
okay.
or maybe they're trying to buy a stock like I did on, so they're buying time that way. Like I bought time because I didn't want to put the cash into the deal,
I
But that said, the
agree.
seller of the time is starting just like the casino. The roulette wheel goes around and there's two greens. So you're starting with an edge. And I think the edge is much higher in options than in the casinos.
Yes, yes, it
That's
is.
only two greens, and you're starting with big option premiums. So with calls and puts.
As I said many times, there was only 1 year where buyers of options beat the sellers. It was 1987,
87. Yeah,
the year of the crash.
remember that.
So that was the only time. I just recently got into my old book, which I read probably 4 or 5 times, and I just stuck into it, and I read it one more time, and I really
Yeah.
enjoy it. It's latest edition of Market Wizards. And I mean, I know all very well what it's all about, but it's a great motivational reading because, for example, if you'll take William O'Neill, and he was a guy primarily dealing in stocks. He's a publisher of Investors Business Daily. And what he's saying is that basically all what he's doing, he limits his loss, famous 7%. So if you have stock position, if it gets in the point that he's losing 7% and it's before the margin. So if it's on margin, it's only 2, maybe 2.5%. So let's talk about neglecting the margin call. So on margin, it's 7%, regardless how strong is the company and what are their earnings and whatever beautiful and wonderful things there are, 7% sold, 7% rich sold. However, when he is winning the trade, he keeps trailing stop loss at 7%. So let's say the stock went from $10 to $20. He keeps the stock, but as soon as it will lose 7% from $20,
Oh, I see. So he rides the winners,
Yeah.
and he
it's
cuts his
it's
losses.
a casino
Cuts
strategy.
his
It's
losses.
exactly what
Yeah,
I'm doing
casino
in the
strategy.
casino. When I play blackjack, that's exactly what I do. The only thing in blackjack, I'm doing 10% stop loss, not 7. But it's exactly the same thing.
Yeah.
And when I winning in a casino, I always keep, sometimes people don't believe to counting your winnings because it's not the end of the game. For me, it's an opposite. You must always know how much is in your bank at the blackjack
Mhm.
table.
Right.
Because once you reach, so let's say I started with say $3,000, I reach $6,000. I keep playing because I may win much more than that. But if I will lose $600 from my top winnings, I went down 10%. The end of the game. I have to take a break, go to another table, another casino. But I have to interrupt the losing process. 10%.
So if you were in
But
the
run out.
S&P 500 as an investment, I don't even understand how this would work. But since the market is down, maybe 20%, whatever this year, so you would have pulled out after the 7% decline.
Absolutely.
But then how would
If
you
I
know
would
how
have
to get?
S&P, yeah,
How would you know how to get in? When would you know how to get in?
Mystery.
that's another
No,
story.
exactly. Yeah, that's the
That's
That's
another
the
trick.
story.
hard part.
How you
Well,
get into any stock? You're analyzing your
yeah.
position. You
Well, I mean,
weigh the risk-reward ratio, and at some point you are convinced that you can get in. And again, even if you get in, the same 7% rule would apply.
Right. So you can only lose 7% of
yeah.
whatever.
Well, you have to look forward, and what we're looking forward to, according to the Fed, is another interest rate hike of 0.75%.
Oh, that's a must. Yeah.
Okay. If that's a must,
Pretty
tell
much.
me, Peter, why would you get in the market now?
No,
when
because the
you
market
know?
knows that.
Well, the market doesn't know everything. Okay, I
No,
mean,
that's the point.
because
The
remember, it's
market
a lot.
doesn't know the
There's
future.
a lot of people in the market, and a
Yeah,
lot of the average person only knows what the average person knows.
that's a
That
good
doesn't.
point.
Okay, so the thing is, the average person should do exactly what Milan said: put your money in S&P 500 and go home. Okay.
Hold
The
hold
people,
Wait. Let me
the
just
people
make,
that
you just
want
made
to
an interesting
be
point there.
sophisticated, that's a different story.
Wait, let me just say something, Dick, because
You know?
here's the thing, and I'll ask Milan this, but look, people have been saying this for 20 or 30 years. This is not new, Milan. I mean, it's a good
Of course,
strategy,
that's
but
right. Yeah.
it's like
It's
just
not a bad
ride out
strategy.
the losses, right? And for 30 years now. And the market's been good, but again, the Fed has been pumping it for 20 years, for 40 years. Rates have been going steadily down for 40 years. So, at some point when they hit zero, maybe this is a change in scenario. But here's the thing: if everybody believes that, and the market really starts tanking, at some point people might say, "Wait a minute, maybe I was wrong," and really get scared because everybody's confident
Yeah,
it'll come back. I'll buy the dip.
because you're right. They have emotional
Think of all the confidence.
parts of the market.
Ron, you're very confident.
But if you
right?
looked into
But-
your crystal ball the next several months, Peter, it's like what all the top analysts says. It's not good because when they pump those interest rates up 3/4 of a point,
Oh yeah.
because there's a lot of people that believe, oh, it's not going to happen. But when it does happen, and they reflect in the market, when it does happen,
Yeah, look at Bitcoin. I
the
mean,
market's going to go down.
Bitcoin
Okay,
Bitcoin
is
had value, but it's the same thing.
you see
People said,
just
"Oh,
a
it's
few-
doing great. I'm doing great," but once it starts going down, the panic starts setting in.
panic starts.
And
Yeah, the
and you know what?
emotional,
After 20 or 30
investors
years of
are gonna come in.
indoctrination, don't sell
Yeah.
don't sell, don't
So
sell.
when
What
you
if this
all
time
this will,
is the time to sell?
it'll all entwine around
How low can it go?
October. It'll all entwine around October because the Feds will start smoothing out the interest rate, and then you get back in October. As they say, sell in May, walk away, come back in October.
You're right about that too. We'll see how
So-
long this takes for this
I
market.
would like to remind that last time Fed raised rate 3/4 of a point, and what's happened with the stock market?
It went up.
No.
Yeah,
Then
they
it
sell
went
the
down.
news. Sell the news, right?
Yeah.
But they're not
So-
going to like the next 3/4, and they're not going to like it if the Fed says they're going to keep raising. But I'm not even worried about the Fed because look, recession to me is almost inevitable. I mean, first of all, we had a minus 1.6 last quarter, and recession's only definitionally 2 quarters, but I think it's going to be a lot longer and a lot slower and
Good
a lot of
summary.
inflation for maybe years. When the market starts realizing, wait a minute, we're in the 70s. The market did not do well in the 70s, and it's been 50 years, so 50 years ago, people in the 70s might have thought, oh, I'll just keep reinvesting, the same strategy. Now, maybe I'm wrong, maybe inflation will calm down and everything will turn great. And then I'll miss an upturn. But you know what? The companies I buy, I buy businesses. I do two things. One, I sell stocks like options like Sasha, where I'm just a casino. I take a bet and maybe I'll cover that bet, but I sell a call. I sell a put, I sell sometimes a 2-year put and just get a huge premium. But then with my stock portfolio, I'm just buying businesses that I think are going to survive this recession and do well. And I have a perfect example. This week is my dividend stock of the pick of the week. Now, Slate Grocery REIT is one I mentioned maybe a month ago. I just upped it from 10.5 to 11% of my portfolio. I love this company. Why? First of all, it just did a deal. This is why I'm mentioning it too, to grow from 1.9 billion to 2.4 billion. This is not such a small company, but very few people know about it. Why? It's a Canadian company, but they own all U.S. assets. They own groceries in the United States. They're mostly Southern groceries, which is the place to be, and they're all open air shopping centers. Over 95% of their ownership, their shopping centers have grocery anchors, and grocery anchors are the place to be because it's guaranteed traffic. Because people have to go to the grocery, and it's not changing. There was a thought, oh, Amazon will start delivering or whatever food, but these companies, a lot of them, are just going to the grocery to get the food and then delivering it to the consumer. So the grocery is doing fine. Kroger is doing very well, as a matter of fact, separately, and I looked at that for a while. But the point is, so you've got a huge, pretty mid-sized company, 2.4 billion as of this day. This deal they just did had a cap rate, which is the most important measure for commercial real estate. It had a cap rate of 6.9%. The cap rate is basically the net operating earning over what they put into the buildings. So basically, it's like a rate of return. So they're getting 6.9. During COVID, they did some other really good deals, even better deals maybe. So they keep growing their assets. And again, these are safe, groceries. Now, and I'm saving the best part for last, but it's got a 7.6% dividend. And it's very hard, again, to follow. TD Ameritrade and E-Trade, if you look them up, they don't have ratios on them almost at all. They don't have PEs, they don't have things like that. So the way I get information is there's a boutique called CAFRA, which is a pretty reliable source of information. And so I got some data from them. And I learned this on Wall Street from Dick York, who's a genius, and he was my first mentor. And he said, always go to the original source, and I use that in a lot of things in politics. If I'm looking at a news story, I look at what the original source said, not what the news story said. But also, I look at the company presentations and sometimes listen to an earnings report. So between those two, I figured out they are forecast to have a very nice earnings growth next year or the year after. And their FIFO and AFO is covering their dividend by either 80% on FIFO and AFO 97%. I won't go into that. You'll have to look it up. But basically, they're covering the 7.6 dividend. But here's where I love it, and this is the best part. So on their new leasing spreads, the ones that they bought in the last few years, and I guess it doesn't count this new deal, they're getting a 38% increase in rents. On every time a lease comes up, they get to increase the rent 38%. On their existing portfolio, they're increasing their rents by 8.9%. So these are the ones they've had for years, and those are huge rent increases. And if you look at the shopping REIT, open air shopping REIT sector, I have a chart, and it's got a history for I don't even know how far it goes back. It goes back to at least 2014, I think much longer, but quarter by quarter, it's steadily increasing rents, 8%, 14%, 10%. It's almost like a line, that averages a very nice increase. So there's demand, and these are the last places that'll go under. Your local shopping mall, like closed-end mall with Macy's, maybe they'll have problems. It depends how bad the recession is. But so people are going to continue to go there. This is why I feel it's a core part of my portfolio, and I'll take 7.6% all day long. And with growth, and they have increased their dividend over the years, not recently, but they have. So it's a really healthy thing for a bad economy and a good economy, and that's why I love it.
Peter, when you buy your security, when you buy that stock, who are you buying it from? You're buying it from someone who is selling it. Can both of you be right?
No, and that's true of the S&P 500. By the way, if you hold it at certain places, they might charge 15% withholding, and other places they don't if it's in an IRA. But it's the same with the S&P 500. Every dollar you put into the S&P 500, somebody else is selling.
But people sell also for different reasons. They sell because they need cash. Yeah. They want cash to go buy. They want cash to go buy groceries. They want cash to buy a house. They want cash to buy something. So the seller doesn't necessarily have to be wrong. They just don't
money that we're going to need in the next 2-3 years does not belong in the market. That's what we tell our members. So because if we put everything in the market, that day will come absolutely when you will have to sell at a loss in order to buy groceries.
Well, fortunately for Peter, he is buying it from people who don't listen to your advice.
And Peter, fortunately, also he's buying grocery chains. So if he needs food, he knows where to go.
Exactly. If the price of grocery goes up, I do better.
Right. In the grocery business, my always favorite was a company by the name Costco. They're just an incredible business where they collect in the fees what people paying annual fees.
I missed that one. I wish
I also miss. I used to have Costco, but when I sold it, I just couldn't find reason to come back. And
because the price is so high now.
Like not only that, they don't pay real dividends. They pay some pennies,
like 1%, maybe.
And that's why I cannot include it in my dividend portfolio. And in a trading portfolio, I always run into more interesting ideas or so on. But by the way, Costco has awesome premiums on their options too. That's something to consider too. But I don't feel like Apple is much sexier company than Costco. Well, wouldn't you agree with that? So if you want to have a bang for your money, you would rather go into Apple than Costco. But Apple is also much riskier than Costco because Costco is just
Apple
unbeatable
probably has
money.
much higher premiums, right? I mean, Costco's probably got a very low premium anyway. And because there won't be surprises either way with Costco. But the market has, just like the S&P 500, you're making this argument, somebody's selling it. But look, the market knows everything, right? I mean, Sasha, you always go to that. So the market knows what the return is. If you believe in the efficient market, the market knows what the S&P 500 is, although it's an average of all different opinions. Some opinions are going to be right. Some opinions are going to be wrong. But if the market's efficient, then all these future returns that are going to be so great on the S&P 500 are already counted in that.
Now, I think all three of you agreed that buying the S&P 500 is the way to go for the average investor.
That's correct.
Yes.
Unless they don't watch this show.
Yeah, if you're not going to work it, then you should.
It's effortless. Couch potato investing.
But I wouldn't put 100% into the S&P 500 either. I would, depending on the age and depending on the situation and everything. Look, the S&P. If you put everything in the S&P 500, or with your strategy of cash and putting more S&P as it goes down, if we're in a period of 10 years where the S&P goes down, or if we're in a period where the S&P goes down 30, 40%, and then you have to work your way back, that'll be a very painful strategy, and nobody knows what will bring in the future.
The biggest effect on portfolio returns is asset allocation and not picking the right stock. When you're picking stocks, you're going to be wrong half the time. Asset allocation. And asset allocation, we can talk about. What works for most people is 50-50, 55-45, 60-40. It doesn't matter the difference. John Bogle, who popularized this whole concept, said he never knew whether 50-50 was the right for him. He didn't know that. We know there's not much of a difference. So 50-50 asset allocation, the market drops, you got excess cash because you got 50-50. So you rebalance. Asset allocation has more to do with portfolio performance than anything else. If the market goes up, you take profits and rebalance. So you're constantly buying bargains and selling, taking profits when the market goes up.
But also on our show, the sectors we recommended, at least Peter's picks, were consumer staples, which yesterday the Wall Street Journal validated consumer staples was a place to be, and energy stocks that pay dividends, where we're at. And if you go back 6 months, because all our shows are recorded, by the way, people are watching. We have literally, Peter, thousands of people watching our old shows. Don't ask me why, but they're doing it. Okay, if you go back, you'll see that we were against crypto stocks, pretty heavy against them. We had crypto experts.
That's an understatement.
That's an understatement. We had crypto experts literally come in, and we just
fought with them.
We slaughtered them. They're not on the show anymore, obviously. But because we're against crypto, and we're against Tesla and ARK and AMC and Robinhood and all this other stuff, which basically showed to be the truth. Now as we're looking forward, because remember, if you have 100% foresight, you're going to do real well in the market, right? So the thing is, if you look forward and you say, what's the market going to look like in the next couple months when you got the Fed going, we're going to raise interest rates 0.75 of a point or more, and you got inflation way up there, how can you say it's, and all the data you get, it's not going to be a rosy picture? How's somebody going to say I'm going to dump a bunch of money in the market?
But Milan, you're saying in the long run everything will work out.
In the long run, we're talking long run.
Right, but the long run could be.
Who knows how long?
Gas hits $6 a gallon or $7 a gallon this summer. If there's some hurricanes, or if or next year when the reserve. They can't draw the reserves down anymore. If gas goes to 6 or 7, the market's going to be really ugly. But yes, in the long run, everything will go up because inflation will eventually catch you. But the long run could be 10 or 20 years.
It could be 10 years.
Peter, $7 a gallon.
That's why you need to be diversified.
Manufacturers of bicycles, because a lot of people will consider like driving season. They will go on the bicycles, and they will get healthier and stronger, save a lot of money on gas.
That's a good idea, Sasha.
That's a good idea.
I'm going to look at bicycle stocks.
Bicycle stocks.
That's an interesting idea. You're right. It could do very well. They did well during COVID, but maybe there's still upside. Because
Peter, I did a study. I did a study for our pension company for these equity index annuities versus the S&P 500. Starting in the year 2000 to 2010, we beat the S&P 500. All you had to do is buy an equity index annuity. Why? Because you start out with the S&P 500 taking a big loss in 2000 and 2001, and it took so long for them to rebound. The problem is the next 10 years, that wasn't the case. The S&P 500 beat the equity index annuity. So we took the study and we threw it away because it doesn't help our cause. Right. But again, at the same time, it's a 10-year. The 10-year period could be the next 10 years.
Who knows?
It may not be the place to be.
Because the Fed cannot pump the market up forever. And
especially if you start with a loss. The minute you start with a loss.
Well, yeah, exactly. If you start with what if you start with, you already have a 20% loss, let's say in this.
And if you make 20% and you make 20% the next year, you're back to even, right?
Right, but you're not going
to wrong. Right. You're not back to even.
That's
if you make 20% the next year,
and the Nasdaq's a lot worse. It depends
if the market drops 50%, it has to rise 100% for you to break even.
Yeah.
Well,
so
will it? Can you guarantee me it won't go down another third in the next 6 months? You can't.
No. We will be buying more. You know what we recommend to our members?
At some point, your cash runs out.
Is when the market is down 20%, as it is now. We recommend that they be fully in the market because it's a bargain. Now,
but once you're in the market and it goes down, you can't buy anymore because you've used all your cash.
Then, if it goes down more,
you don't have any more cash.
We talk about borrowing money.
Oh, now you're going to borrow money.
That's right. Now, very few advisors would recommend that you borrow money to invest, even though a margin account is exactly that. That's what.
What if the market goes down for 5 years? Now you borrowed money and it goes down another 20%. I mean, the market is not totally predictable.
Could do that for the next couple of years. I mean, that's what we saw in 2000, 2001. I mean, it was just like
1970 is the better model, right? Because when inflation kicked up through the roof, the market did really poorly in the 70s.
But wouldn't you admit that in 50 years, past 50 years, market changed a lot with the electronics, internet, electronic trading? All processes that used to take years before, now they could be over in a couple of months, in 4 months, maybe or so. Actually, with all this market downturn lately, I still see that even Nasdaq and most of the leading stocks, they're holding relatively well, because I would accept that even leading stocks should lose at least 50% in a serious environment like this with inflation or so on. But they're holding their own. Even
they're quality companies.
Even yesterday, look at yesterday was quite heavy down day. Dow Jones went down 500 points, but even technology stocks, they lost money yesterday, but they held their own. They were always buyers. So I was thinking, okay, so people probably selling because of the maybe margin calls, maybe some other reasons to go to buy groceries. But they're holding their own because they were always buyers on the other side.
You know, in the long run, tech would probably do well. As a matter of fact, if I had to be in one sector that would be risky right now, I would be in tech because they're growth companies, so eventually Amazon, Microsoft will probably grow out of their losses.
No matter when.
And because they're growing faster than most companies.
Peter, once the market will stabilize, or if it will find its bottom, and
we'll see.
For me, the bottom is extremely high volume. The people are selling left and right. People are forced to sell. People are willing to sell just to forget about it. Now, after that, market will have to start recovering. And there is no substantial recovery without participation of leaders of high-tech companies.
Let me bring up one last point, which I was going to bring up, and we could discuss this next week. But, there's a theory that the market leads the economy and not the other way around. So, and this makes a lot of sense. The market starts going down. People are like, I better stop spending money. I've lost money. I lost a fortune in Bitcoin. I'm not going to spend as much money, or I've lost money in the market. So nobody knows. Nobody's been able to prove this. Does the economy lead the market, or does the market lead the economy? But if the market leads the economy, we could be in for quite a ride. until we hit that bottom. So we'll find out show by show, and in 6 months, Milan, we'll see where we are. But I wouldn't put a penny into the S&P 500 right now, and you would put everything in. So we'll see who's right. It's June now, and so far I've been pretty right on my calls, but we'll see.
Okay, I would like to thank you all for participating in our program. I think it was very interesting discussion, and looking forward to see you next week. Have a successful week.
Sasha, can you stay on for a second, and Nick?
Yeah.